please do so.
I'm delighted to continue, but I want to thank you for that commercial. Um, yeah, so the first item on the agenda is the approval of the minutes. Is there a motion to approve?
Motion.
Second?
I'll second.
Motion has been made and properly seconded. All those in favor say aye.
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 Ayes have it. It looks like the second item is the investment performance review. But before we go there, let me just apologize for not being an active participant in the May meeting. I was sitting here at my desk and said, "Oh my gracious, what have I done?" But I did catch up with the guys, and I was briefed on it, so I think I'm in pretty good shape. So with that, let me turn it over to who's going to take it from here.
I'll just comment. I'll comment briefly, Don, and then let Alex go through the numbers and some market commentary. It's obviously been a continued, extremely challenging market. As you know, it takes about 10 business days following the close of the month to put out the prior month's reports. So we're shooting to have that to you on Friday, the June numbers. Some folks were talking briefly before the meeting started. Obviously, the inflation numbers came in extremely hot again this morning. I think 9.1% year over year. And I saw a headline flash up that traders, bettors, however you want to put it, now forecast it's gone up about a 42% chance of a 100 basis point increase at the next Fed meeting, which is a sharp jump from where we were, probably were just yesterday. I would also just say, if you look at the, numbers just of the indexes, we continue to be really in somewhat uncharted territory. I know we've talked a little bit about this before, but, just to see, and I'm just looking at, they're not in front of you, but, index performance as of the end of June. Again, we continue to see stocks and bonds struggle in near lockstep. For the 1 year period ending June 30th, the Barclays aggregate was down 10.3%. The S&P 500 index was down 10.6%. So you would have lost nearly identical amounts of money, whether you were in an all stock or all bond portfolio. Some of the international indexes doing even worse. The emerging markets index being down over 25%. So again, a very challenging market for all investors. I will turn it over to Alex, but I will just say that I continue to expect that we'll see elevated levels of volatility, whether it be the short-term rallies or declines on whether it's news out of Ukraine, oil prices, inflation readings, consumer sentiment, reports that come out. I think we're in for continued volatility throughout at least the remainder of this calendar year. And with that, I'll turn it over to Alex to go through the report.
Thanks, Chris. Yeah, and you're obviously spot on. I think, your sentiment is similar to ours. Floyd will provide a little bit more detail on our macro thoughts in a minute. This on the screen is the market value as of yesterday, or the end of the day yesterday. You can see, 562.65 million. I think the value we saw on the prior page from May was 586.7 million. June was a difficult month, for all asset classes, as Chris said. I think the ending market value, and I have it just on the back, just written down, if you give me a second here, on June 30th was 545 million. $682,581. 545-682-581. And that's preliminary. Taking into account benefits paid, that's roughly a 6.5% loss for the month of June. Stocks have recovered, somewhat through July. I think the U.S. markets are up roughly 1.8 to 2% as of yesterday. International markets struggling in negative territory for July, and bonds recovering somewhat. But so the portfolio is recovered, as you can see, as of yesterday. But obviously, I think the big question on everyone's mind is, are we headed for a recession? Is the Fed activity in response to the inflation that Chris referenced going to slow economic activity to the extent that we dip into recession territory? There's a lot of things we're watching. I think hopefully, Floyd, you have some recent data on consumer and corporate health. That's certainly a big element that we've been watching. And obviously, the data is day to day with, the strong figure coming in this morning, capable of changing the landscape. So with that, I guess I'll turn it over to Floyd to talk big picture macro.
Hi, everybody. Hopefully everybody's doing well. It definitely has been interesting. Chris, thank you for highlighting inflation. This was something that I think if you notice my comments over the past couple meetings, I've made sure to ensure that we temper our expectations for things leveling off. I think that that's something that people were hopeful for, but if you think about reality, hopeful and reality do not always come into play, and you're seeing it right now with inflation per se, especially when you think about it that during the summer months, especially in June, July, people are moving around a lot. So, that's a time when gas prices are always high. So kind of expecting inflation to decrease for the month of June, and June was one of those pipe dreams I think people had played in their mind. So when you look at the components of inflation, I think that's where we should go towards. You have the owner's equity rent portion, which makes up about a third of CPI calculation, and when you look at that aspect, even at housing increasing year over year by 6%, that still leaves you with 2% of guaranteed inflation without blinking. So, if when you're looking at that aspect and kind of saying, well, if I know I'm going to have 2%, then a lot of other things have to essentially, quote unquote, hit deflationary territory. And from what you've seen, you will see energy go down some. It's starting to go down. Currently, as we speak, it's been on the skids for the past couple of days to weeks during July. But if you're looking at it from a food inflation portion, food inflation has been here since before the pandemic. We've actually had food crises before the pandemic. It's just remained under the seams. Now it's coming to play, and it's going to probably stay in the numbers for a while. So inflation, just like unemployment, goes up like an elevator, down like an escalator, and it has not gone down yet. So to Chris's point, right now the Fed funds rate is about at 1.75. Expectations would be at least to see another 0.75 to 100 basis points raise. That will put them right in the range of 2.75 or 3.5. Oh, sorry, 2.75 or 2.5. If you were thinking about a Fed funds rate by the end of the year of 3.5, that's probably where we're going to be. If you have to go towards that 4 number, that 4 handle is going to be an issue for us. This week coming in, this week is actually a pretty important week. If you think about it from a consumer health perspective, you have a lot of the banks announcing this week. The key would be to focus on the loan reserve aspect. If loan reserves are increasing, that essentially says from a banking perspective, banks are looking at us going more and more into a recession. Now, currently, if you were to say, hey, Floyd, are the recession risk increasing? Definitely. From a firm perspective, do we see recession within the next 12 months? As of right now, no, because when you define recession, it actually is based off of unemployment and PMIs. If you look at the unemployment is going to have to spike. And right now we have a shortage of workers technically, so you won't see that aspect. From the PMIs PMIs still look good. They're still above 50. But just because they're above 50 here doesn't mean that they're above 50 globally. If you're looking at it actually across seas, the UK is probably flirting with a recession right now. Europe right now, their PMIs are low. They're having just as many issues with inflation as we're having. They're a little bit delayed. They did not recover as much from COVID. If you think about the equity turns and the recovery from just a market perspective, along with the headwinds that they have coming in. So they're in a pretty fungible place. If you think about it, even with the whole talk of the euro now being in parity with the dollar, this is something we haven't seen for 20 plus years. That lets you know right there kind of what they're dealing with, and they're going to have headwinds going forward. Japan, I think everybody saw the news about Abe, the former Prime Minister Abe, unfortunately being assassinated. When you think about his legacy, he did the three-legged stool type of legacy. Will that help Japan get some type of inflation? If you're looking at the numbers, it looks like no. But the one interesting thing about Japan, they rely heavily on China. So as China starts to if they start to come out of this COVID recovery, they're trying to do it in bunches now, as opposed to kind of saying lockdowns. So as China comes out, it's actually positive for Japan as a whole. But if you were to kind of say, okay, well, developed markets don't really look as great. Chris, you highlighted the emerging markets portion. You see it within the returns. So within Asia, China actually might look a little bit better going forward just because they're coming out of being in COVID lockdowns. If you think about it, China kind of led us into COVID market-wise, led us out of COVID market-wise. They've been down for the past for the past year. It seems like they're coming out of that malaise period, but it won't be the old China that we're used to seeing going forward. But if you look at the emerging markets as a whole, Latin America is starting to really feel the pinch of inflation. And you're starting to already see the food crises across various regions. You're seeing it in Africa. You're actually seeing it within Sri Lanka. I think everybody's talking about the gas portion, but they're missing the food. They're missing everything else going underneath. So you're starting to see a lot more social unrest, which is not good for the markets, and it creates a lot more instability within that emerging market region. To Chris's point, you are seeing a lot more uncertainty across the globe. If you're thinking about it from a positioning aspect, sometimes it's just, as opposed to saying I want to take more active risk, it might be times like this that you actually want to lessen some of the active risk that you might actually be taking and get a little bit more benchmark and take some of the risk off the table.
Floyd, what are obviously you mentioned our firm position is we're not expecting a recession. The chances have certainly increased, and you gave a lot of the reasons for that. It's week to week, if not day to day. What are some of the positive tailwinds that are leading to our view? Aside from the labor market, you did reference that.
Right. I think you have the positive tailwinds, you have a positive labor market. You're still seeing consumer spend. Now, the sentiment is probably the portion that is in the toilet. If you're looking at sentiment is, at multi-year lows. You haven't seen this lows actually since the global financial crisis, and that they're below that. So that lets you know people are very bearish going forward. Other indicators that probably would put that smile on your face when you're looking at it. If you're looking at it valuation-wise, valuations look really good. So if you're looking at valuations as an indicator of kind of, where people are looking and probably could look within a market, that's a positive sign. If you're thinking about corporate balance sheets are very healthy. If you think about for the past couple of years, they've lowered their debt payments. There actually hasn't been a lot of defaults within high yield. Now, the one thing to watch going forward, and the one thing we'll have our eye on, is when you have the senior lenders or / loan surveys, what's the temperament within there. I think that's something that we're going to be watching going forward. But high yield actually has not gone haywire. It was a bad month in June, but beyond that, high yield has actually been pretty good for the year as a whole. And on top of it, corporations are still profitable. They've been able to pass on the expenses to consumers. So you are seeing that within there. The question is now, how long can they pass it along? And will we, can businesses still be able to operate well. Profitability will get hit, but if it gets hit, will it, will it still stay in positive territory or will it go into negative territory? Right now, it seems to be positive territory, and a lot of the jobs that you're hearing being laid off, if you kind of think about it, you're seeing a lot more in the tech sector. And a lot of the jobs that are really more quote unquote high paying jobs within the tech sector. So it might be more of that sector getting their cost under control, which probably have been insane for the past couple of years because of they've been able to mask that with high stock prices.
I think, yeah, Peloton, a very good example that I just saw yesterday.
Yes.
So, well, thanks. That's a good summary of, our position when getting back to the portfolio. Overall, the portfolio remains, with a tilt towards equity, primarily domestic equity. A slight overweight to credit and high yield. All of which should benefit quite significantly if there is no recession. And I think that kind of gets back to when Floyd was talking positioning, it's where do we go? I think you have to kind of be prepared for both cases, without taking too much of a stride, one way or the other in a period like this. There does continue to be a number of tailwinds that have helped the plan year to date, despite the tilt towards equities. Among them, active management, across the board has generally been quite strong. PineBridge has recovered nicely, particularly within international equity, which has been a difficult place. I don't have the peer universe data in front of me, but the vast majority of active international managers continue to underperform their benchmarks on a year-to-date basis. Acadian and Ernest continue to do fairly well. Further, the high quality S&P 600 allocation that we have, from the Rumline small cap, not to mention Copeland's focus on high quality dividend growers, has benefited the small cap allocation. So active management, has benefited the plan thus far this year. The defensive cash position that we took at the beginning of the year, right at the onset of the the Russian invasion, has helped. I can't see it on the page, but I think there's roughly 17 million or so in cash right now, which is a little over, 17.8 million or so. I think we have more than half of the year left in cash, so no need to sell any positions. As Floyd mentioned, valuations are attractive, but we'll have an updated performance report on Friday. We expect it'll have the final market value. Floyd, you want to say something? You're on mute.
So one thing I want to point out, and I think and Alex can definitely chime in on this. Your active managers and your active manager performance is not indicative of active managers as a whole during this period. Some of the biases that your active managers have skewed towards, Alex brought this up, and I think this is very critical and crucial. I want to make sure that you guys understand. Everybody's been saying it's a value rally. It really has been pegged off of energy. Outside of energy and really utilities, everything else has not done as well. Alex pointed out the dividend yield aspect. Dividend yield has been one of the best performers domestically and internationally. That, during go-go times, it's not always the best place to be. You'll keep up with the market, not as much. But during downtimes like this, that you're seeing that honestly, a lot of everything's getting hit. That's been benefiting you a lot. And I do want to make sure that you guys understand that aspect, because you won't see it in a lot of other portfolios. The way that you constructed this, the way that this is constructed, is very unique. So that's something to be commendable.
Yeah, Floyd, thanks. Alex, if I may, Floyd, thanks for bringing that up. I was going to ask because you recommended a lessen the active risk. And then Alex turned around and said how good our active was doing. So I appreciate that explanation. And today's Wall Street Journal said the dividend payouts hit a quarterly record. So and that's 2 quarters in a row. So that's been helpful with the dividends. But I had a question concerning the labor market, Floyd, to go back to what you were talking about, or Alex, whoever wants to answer it. The tech industry, and Alex, you mentioned Peloton, but it goes way beyond Peloton. Tesla, other Silicon Valley companies are shedding staff, shedding a lot of staff. Offers to employees are being rescinded just weeks prior to them starting. I believe that has to have a trickle down effect. I think it has to be more than the tech companies over hiring people because of the value of their stocks. Why do we not expect a trickle down theory, a trickle down effect in the labor market because of the layoffs in the tech industry? I mean, the tech industry is a big industry in this country. Those workers have to try to go elsewhere. Are we going? It's going to create, I believe, a you know. I guess too many workers maybe for possibly not enough positions, especially going forward if we're facing anything close to a recession. I mean, how do you expect that will work out? Am I looking at that too simplistically, or is there some other way to look at that?
The only before I have pass off to Floyd, I don't know the specifics of the industry enough and those specific jobs to address the loss of income, for example, or whether they shift downward. From a broad macro perspective, there's a great deal of open positions. But again, is this viewed as like it was seen several years ago during the the Great Recession? Are these tech employees then seeking lower paying jobs? Will there be an effect from that? I can't say the specifics, but to the shortage of jobs, the overall data points to no. But Floyd, I don't know if you have any.
Yeah, Alex. And Fran, actually, that's a really good question. When you think about that, the one thing I'd point out is that because we've had a lot of friction in the labor markets, people have moved. You've created people have moved, but also companies have been a lot more progressive in the way that they think about the hiring aspect and putting people in certain places. So one of the things that I pulled up as you were talking, I'm thinking about what you were asking about. I look at the labor participation rate. And so when you're looking at the labor participation rate before COVID, it was at a good 63.4. Currently, it's at 62.2. So you still have a gap. So between that along with a very essentially low unemployment, which is way below our usual means, even with those individuals that are quote unquote getting laid off from tech, they'll more than likely be repurposed into other jobs and or opportunities. Now if you're looking down the trickle down effect with that, I do think that there will be a repricing within some of their skills because, they're going to have to go to other industries, which have been looking. And right now, tech has been the highest paying, so everybody's been flooding in there. When they go to the other industries, the repricing is probably going to make them take a pay adjustment. Because I look at it like this also, like when you think about for city hiring per se, city hiring competes with with corporate hiring, and now when they're looking and saying, okay, well, I have a choice between, I used to have a choice between working for tech in a city. Now that tech corporation is getting a lot more leaner and being a lot more stringent with their expenses. Um, that allows for some workers to really consider that city type of job that wouldn't consider it before.
Yeah, that's well said, Floyd. I mean, I think the same thing happened again back after the the global financial crisis in the investment banking world. Salaries went down, expense accounts went down, et cetera, et cetera. And I think a lot of those people were oddly enough directed into tech, and here we are today. There was another element I wanted. Just getting long-term trends of thinking about the tech sector and productivity. Productivity growth remains very strong and has been. A lot of that is coming from gains in the tech sector. So again, when you think about high salaries, et cetera, and repricing, it is very interesting. There's probably a lot of to be, again, uniquely about that sector that could be added to this discussion. So does that help
Yeah,
a
and
little bit, Jerome?
it helps, but as we know, the consumer is the main catalyst for everything. And if we're looking at pay cuts, we're looking at, as Floyd, as you call it, I like the diplomatic term of repurposing jobs. But let me tell you, a tech person isn't taking a hospitality industry job. They're not doing it. So I think I think we're going to see an effect on consumers, especially, by the way, if the interest rates increase the way they are, we're going to see a depression in the housing prices, and therefore a depression in the people's ability to quote unquote borrow from their houses. So I think it could be an interesting situation going forward, for consumer spending, and that will have a direct negative effect on the economy. So that's what worries me. Not so much necessarily the job itself, but the the pay of the jobs and the reduction in order for those corporations to keep those nice balance sheets, Alex, which you referred to earlier.
I mean, again, this is mostly anecdotal. I'm sure there probably is some data about crossover between tech sectors and healthcare and financial services, with high paying jobs across. I mean, their intersection, right now is undeniable. So, I'd be curious to see some data on that. I think we'll look into that and get back to you if I find anything interesting.
It'd be helpful
About,
because
yeah.
the mortgage industry is shedding jobs. Banks have shed jobs. I mean, there's a lot of industries besides techs that are shedding some jobs right now. So we'll see. We'll see how the earnings go. I'd be curious as to your if you can look into that, maybe at the next meeting and come back and give some real data, because there are different things you read in the Wall Street Journal and you put them together, and it's concerning. I mean, and you've expressed that the concern going forward. So I appreciate it.
One last thing that I'm just going to say, getting back to sort of the active managers, on that, those of you who've been around through a lot of the searches or even just the discussions we've had that review them, you'll know when we've gone through the RFP process and have interviewed managers and the managers that we've brought in, we're looking for a manager that can be hired because of the nature of the contracts you have, 4 years, et cetera. We're looking for managers that are, full market cycle managers. And as a result, I think we've tended to have a bias towards high quality, looking for managers that will defend on the downside. A few of them have done that in the, I think, select period that we've seen over the years. But we've also noticed, you can think back, there have been some issues with managers, and I think a few have been on watch list in the past, not keeping pace with their benchmark. But I think the results of that that lens that we applied to the search process, part of that is being shown, I think, in their active performance year to date. So it's not typical. Unfortunately, it's not typical of the mutual funds we utilize in our discretionary program, particularly on the international equity side. Again, most international equity funds have fallen, quite below the benchmark year to date. It's been a good process reviewing and holding on to Acadian, Ernest, and PineBridge as well. So just keep that in mind, and that's kind of how we ended up in this position, and kind of the general approach we take to the portfolio as well. So I think that's kind of our comments. Any other questions or items to discuss? Well,
could I ask a question? And you guys may have covered this. Has the consumer pulled back in their position relative to the economy? Are they purchasing less, or is it par for the course? They're just as strong as it was in the past.
I think Floyd will hopefully have the most up-to-date data.
I can answer that now. If you look at consumer spending, consumer spending is still increasing. So you haven't seen a quote unquote pullback, but I think within that aspect, you have to break it out between services and goods. And, during the pandemic, it was all about the goods. Now it's all about the services. You haven't seen services turn over yet, Don. That's the key portion. This is the summer month. So I would, if I was looking for a services turnover and spending, I'd actually start looking more to August, September timeframe. Once people go back to school, how much are they going to, quote unquote, tighten that belt? People have been locked in for the past 2 years. So when you think about it from a behavioral aspect, people are not going to want to cut down their spending right now because of things going on. And those are the people that actually can spend. So I do want to preference that, because if you look at the way that the incomes are broken out, you do have a good portion of Americans that, if you look at the savings rate is definitely skewed to some that have a lot of higher balances and those that actually really never have any balances. So you do see that in there. Within the consumer aspect, though, and I think this is something I should know because Fran hinted toward this. But if you're looking at some of the credit card data, you're starting to see that spending and those balances start to increase. So, it's going to take a little bit of a time for that to trail off. But when that trails off, because they don't have the money and they have to start using it other places to essentially pay down debt, that will be the focal point. We're not there yet, but that is a point. What Fran got towards, Don, what you're pointing towards, and within the consumer, that's what we're staying on top of, and I think you should stay on top of.
And actually, speaking to consumer confidence, I think, Floyd, you referenced earlier, we're at a low point right now, a 2-year low point, basically going back to the depths of COVID or the COVID summer. We were coming off of a 20+ year high. I mean, consumer confidence to start this year was the highest it's been in over 20 years. Now it's been a precipitous drop, and I guess, like you said, it's been interesting. We have not seen to this point the spending trail as much, but we're watching it closely, and we're seeing we'll see data come in each month. So, any other questions, Don?
No, that's it for me. Any other questions, gentlemen? There being none, is there a motion to adjourn?
Don, I just wanted to remind folks real quick, we will have the annual actuarial report at the September meeting. I've begun talking to the outside firm about that. We're also coordinating with the outside auditing firm as well as the city accountants about the annual audit, where we'll use some of the data that comes in around the same time for that. So we will incorporate that into the next meeting. That will, of course, include the stress testing and some of the other things that we've talked about at past meetings. That'll be part of the actuarial presentation in September. And then lastly, I just want to take a moment to thank Bill Rubin. Unless he joins us as a member of the public, this will be his last meeting with us at the PGW as a city employee. He'll be on to a well-deserved retirement at the end of the month. So I just wanted to thank him. He's previously served as an alternate on the board in the past, designee. He's handled tech aspects for us for the past couple of years, and just wanted to thank him publicly for the work he's done for us over the years. So thanks, Bill. And with that, Don, turn it back over to you.
Thank you. Yeah, Bill, I'm gonna tell you, man, being a retiree, man, you're gonna have a good time out there.
I look forward to getting down to see you and play a little golf.
Yeah,
It's not done yet. We have 2 weeks to convince you otherwise, Billy.
There you go.
All right, guys. Is there a motion to adjourn?
I'll make the motion.
All right.
All right,
so
second.
moved. Thank you. So move. Have a good one. Bye-bye.
Congrats, Bill. Take care,
Thank you.
everyone.
Congrats,
Yeah.
Bill.
All right, bye, everybody.
Take care, guys. Thank you.